We got some huge news for Meta stock investors as the company announced it will be borrowing $30 billion. Now, I'm going to talk about the details of the announcement and what it could mean for Meta stock investors. And you're probably going to be surprised by the conclusion. It might not be as bad as you're thinking, or it might not be what you're thinking. And I'm going to clear up those details here. You're not going to want to miss. Let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Meta Platforms is planning to sell $30 billion of investment-grade bonds on Thursday, the biggest high-grade bond corporate offering of the year. And the company received record orders for the debt. And what that means is demand for this debt is very strong. Lenders want to purchase, lenders want to lend money to Meta Platforms because they feel relatively comfortable about getting their money back and making a good return on their investment. So they're happy to lend the company money. And I'm not surprised. Meta Platforms is a cash generating machine. It operates on profit margins, operating profit margins that is above 40%. Really lucrative business model, very low debt to equity ratio. So it's a relatively safe bet for lenders to give Meta Platforms money. So all that being said, why is Meta Platforms even borrowing $30 billion? Is that a bad sign? And I know most of you, that's the conclusion you might jump to. If a company is borrowing money, that's a bad sign because they need money. And typically, when you see somebody looking to borrow money, you might jump to that conclusion. But I'm gonna talk about some reasons why it's not such a bad sign. So first of all, let's look at why Meta needs this money or why they want this money. So for the full year in 2025, they expect their total expenses to come in at around $117 billion. And then capital expenditures for 2025, they now expect to be $71 billion, up from $69 billion. So their spending overall for 2025, they expect will be $3 billion more than what they previously thought just 3 months ago. And then they went on to say, as we begin planning for next year, it's become clear that we need more computing power, even more than we thought 3 months ago. So we expect to invest aggressively to meet these needs, both by building our own infrastructure and contracting with third-party cloud providers. Our current expectation is that CapEx dollar growth will be notably higher in 2026 than it was in 2025. In 2025, it's when it's all said and done, it's likely that it will have increased its CapEx spending by roughly $30 billion. So then in 2026, it's going to increase by more than $30 billion. So that's the reason why the company wants to borrow this money, or one of the reasons why they want to borrow this money, because they're going to use it. And that's a good thing. When you see a company that sees an opportunity, especially a company that's been as successful as Meta Platforms, a company that's been great at allocating capital, you're okay with that company. I'm okay with that company spending more money to capitalize on a growth opportunity. They're seeing this demand, they're seeing increasing usage for their products and services, and they need more power to serve those needs. A lot of the things they need is associated with computing power, because when you're engaging on their social media apps, consuming video content, uploading images, interacting, that all requires computing power. And the more engagement, the more computing power they need. And what we saw from their most recently completed quarter, with revenue accelerating 25% year over year growth. That's the fastest growth rate they've reported in several quarters. And so with demand increasing, they need more power to support that increase in demand. And here's another reason why it's not really a bad sign. So I want you to take a look at this blue section here. What you're looking at is my proprietary discounted cash flow valuation model. And as part of this valuation model, I calculate a weighted average cost of capital. Now, when you're starting a business, whether you're a very large business or a very small business, there's only two ways you can fund that business, either with debt or with equity. Okay. Funding your business with debt would mean going to your credit card, taking out maybe a $1,000 cash advance to start up your business. Okay, that's starting your company with debt. Starting your company with equity would mean that you already had $1,000 of savings in the bank and you use that $1,000 to start your business. You would be the equity investor and you would own 100% of your company. Another way you can start your business with equity would be if you go to your family members and you tell them, hey, everyone, why don't you all chip in $100? There's 10 of you, and I need $1,000 to start my business. And for all 10 of you, I'll give you each 5% of my business. Overall, you all will have half of my business and I will retain half of my business. Again, that would be starting your business with equity, but equity with shareholders. Okay. Another way you could start your business with debt would be to go to your family and ask them to lend you $1,000 and you would pay them 10% interest annually until you pay back their money, right? So those are the only two ways, either debt or equity, you can finance your business. For companies like Meta Platforms, the cost of debt and the cost of equity differ significantly. For companies like Meta Platforms, the cost of debt is significantly lower than the cost of equity. Meta Platforms in 2024 generated $50 billion, nearly $50 billion in cash flow. So it's a cash generating machine. It's expected to generate $57 billion this year, $65 billion next year. Lenders feel comfortable lending to a company that generates this much cash flow with very high profit margins, strong competitive advantages. So lenders are willing to lend Meta Platforms money at a relatively low cost of debt. I estimated that to be 6% cost after tax. That's another benefit of borrowing money, is that the interest expense is tax deductible. So you can reduce the amount of your interest expense by your tax rate. And so your after tax cost of debt now even creates a bigger gap between your cost of debt and your cost of equity. So I mentioned the cost of debt I estimated at 6%. Look at the cost of equity. So that's the CAPM. That's the capital asset pricing model for short. That's the way I calculate a cost of equity. And for Meta Platforms, their cost of equity is 11.3%. So it's nearly twice as expensive for Meta to raise $1 from equity than it is for Meta to raise $1 from debt. And so you might be saying, well, Meta won't raise any dollars from equity. They're not going to sell any more stock. But that's where you might be mistaken, because if Meta Platforms generates $1 in profit and they do not pay $1 in dividends, they're retaining some of that profit as a retained earnings, which then reinvests into the company. They're essentially using equity to fund the growth of the business. So by borrowing money, they don't have to use as much equity to reinvest in the business. They can use more of the equity to pay an increasing dividend, which they have been, and do more share buybacks and reduce the amount of financing, right? So look at the capital structure. Meta Platforms, before this debt announcement, had about $29 billion in debt, and the market capitalization is $1.64 trillion. That's a big difference between their total debt and the total market cap. So the debt to equity ratio is relatively low. And when you consider the big difference of cost of equity versus the cost of debt, and you can see the weighted average cost of capital is 10.8% because they have so much more equity than debt. So if they borrow more money, balance this capital structure more towards debt, the weighted average cost of capital can decrease. And if the weighted average cost of capital decreases, the value of the business will increase the intrinsic value per share, because all of these cash flows are discounted at this weighted average cost of capital. And so if the weighted average cost of capital decreases, then these cash flows are discounted at a lower rate. And so that lifts the intrinsic value per share calculation. I know that's a lot of wonkiness, a lot of financial engineering talk here. I teach a lot of this stuff in my corporate finance class at the university level. So sometimes I teach this stuff to master's level students, MBAs, masters in finance, etc. So I'm hoping that I simplified this enough. But if you have any questions, feel free to ask in the comments section and I'll be happy to clarify anything further. By the way, did you know about our exciting channel membership program? You get so much for less than $5 a month, including dozens of exclusive videos, access to exclusive research on over 100 stocks, and early access to many of my videos before everyone else sees them. Click that join button below to learn what this program is all about.